What's happening, hardscapers? This is episode 347 of the How to Hardscape podcast. We talk about how you can start and grow your hardscaping business. And on today's episode, we have Cycle CPA taking over the episode. And in a world full of webinars and all these different things that you can sign up for, Cycle CPA really did a great job on their 2-day virtual event on building a 2026 budget and financial plan for your green industry business. They did this collaboratively. They asked 20 others to come on and do 15-minute segments on a specific part of creating your budget. I joined in, I sat in on it. It was excellent. Just great to hear a whole bunch of different aspects of the budget and how people tackle actually being able to budget for it, as well as hearing from Joe and Carla at Cycle CPA talk about forecasting for revenue and then on overhead in the second day. A couple different talks from them. But if you did not sign up for that, you definitely missed out, and you're going to want to stay tuned for this year's if they do one, because this was definitely unique. It was interesting, it was engaging throughout, and they evidently put a lot of effort into this. But it's also great because their first day talk on forecasting for revenue and their second day talk on overhead, they service the green industry. So hardscape, landscape, lawn care, maintenance. They have benchmarks and KPIs, key performance indicators for our industry based on how many companies they actually do their services for. That's bookkeeping, accounting, CFO services. So they have a lot of data to be able to benchmark you as a hardscape, landscape, maintenance, lawn care business against, and help to guide you in the right direction on those. It's definitely one of the main benefits if you are looking for bookkeeping, accounting, CFO services to be able to go with Cycle CPA. So for today's Cycle CPA takeover episode, I asked them, can I take your first day and second day talk and just sandwich it together and put it into one episode on the How to Hardscape podcast? And thank you to Joe and Carla for letting me do that. So you're going to hear both of those talks in this episode, and definitely do not miss if they do another one of these events this year. Definitely sign up for it, as well as check out their services, cyclecpa.com. Go to Instagram, cycle_CPA, and they have a Facebook group, Landscaping Accountant. Just a lot of great content that they put out, even on their website with their blogs as well. So definitely check them out and get a conversation started with them today for any of the services if you are interested. And without further ado, let's get into today's episode.
Carla and I wanted to share some key points as well in regard to building out a sales forecast, also looking into certain benchmarks and other details when it comes to the whole budget process. In regard to revenue goals, and I should say, even looking at the green industry and the revenue growth that we've seen based on the benchmark. So as we mentioned before, we work with over 400 companies in the green industry, and we kind of compile that data. And that's part of how, what we show in regard to reporting with our clients is we can show your profit and loss versus how the other companies are doing, right? And as part of that, looking at the revenue growth. So the companies that do a lot of the mixed, whether they do install, tree services, maintenance, so they don't provide more than 75% of any given service line. They saw revenue growth of around 9.65%. Installation-based companies were around 15.8%, and reoccurring-based companies and kind of like the less material-intensive companies, close to around 9.91%. And it's important to understand where that industry median is when it comes to revenue growth, because ultimately, if you're above that metric, if you're growing faster than the average company, then there's going to be more investments into the company, right? Your cash flow might not be as good as companies that aren't growing as quick. At the same time, if you're growing slower than industry average, I think that's even more of a reason to really dial into profitability, right? Some consider maybe going into profit mode, or really trying to dial into, okay, how can we make sure that the operations are efficient? Dialing into things like route density if it's more of a route-based company. So really kind of looking at these benchmarks. And then even when it comes to, can we build out revenue that is realistic? And Carla, I'm sure you see a lot of different numbers in regard to revenue targets.
Yes, I do. And I think, so one of the items that, not last year, but 2 years ago, we were seeing a lot of companies have unrealistic sales goals. And what happens with that is you're setting up a budget that, you know, is unrealistic, because if your revenue number is unrealistic, there's just so many expenses, like Joe said, that is tied to that. And then it doesn't become like a relevant document for you to look at every single month, right? It becomes something that you can't rely on. So being realistic in your budget is, I think, one of the first things that you have to think and ask the question to yourself is like, okay, if the average company in the ingredient industry is growing at almost 10%, but because of my market, because of my name, because of my marketing investment, you know, and my track record, I can grow at 20% next year, then that might be a realistic goal for you. But if your track record was growing at 10% and all of a sudden you want to grow at 40%, and that's how your budget is set, is more looking at, okay, well, how am I going to make that happen? Am I going to change my marketing method? How is my advertisement going to change? Do I have the cash flow to make that happen? How am I going to change my hiring practices, because now I'm going to need 4 new crew members, more different sub relationships that I may have to, you know, have in order to make this change. So I think that if you're thinking about what is the revenue growth, and just because your variable costs, the costs that fluctuate as your revenue fluctuates, is tied to that, is super important to start off with a realistic picture.
Yeah, and if you find yourself in July of 2026 and you find that you're behind on your revenue goal, but you didn't update your budget, and in your budget you mentioned, oh, I can spend 4% on rent costs, but you didn't update your budget. Now you might think that you can afford more on that than you realistically can. So it's important to reassess that throughout the year.
Oh yeah. A budget is not, it is, so a budget is not a set it and forget it. And I think that a lot of us look at it that way. And to a certain point, yes, like, I'm not saying go ahead and change your budget every month. Like, that's not the right way to go about it, because a budget is supposed to be a little bit of a stagnant, you know, numbers that we're looking at, right? But for example, in our meeting cadence, we have it that in June or July, we look at the budget, and now it's the time to reassess and maybe update some numbers in your budget for the rest of the year if something is not looking right, or, you know, so that way at least mid-year you have a plan, a revised plan for the rest of the year, and so you get the outcome that you want. So I think a budget revision once or twice during the year, it's really not bad, and it's beneficial. It's beneficial because, you know, things happen during the year that you just might not be able to forecast, right? Different events might happen, personal events, business events, whatever it is. And some of it may be favorable, other events may be unfavorable, but that's okay. You still want to update your plan. But I think that, you know, updating the budget numbers every month is not something that you're going to want to do. That's not what we're saying, but definitely revising it once or twice a year.
Yeah. And trying to base it as much on data as possible. And I think the reason why we're talking about revenue, and I think a lot of people think in terms of, yes, profitability is enormously important, right? But building that revenue up allows you to build in a lot of those different expenses, right? So that's why you want to be as accurate as possible with the revenue, because a lot of items are relative to that, right? You're going to look at a lot of your expenses maybe as a percentage of total revenue. So you want to look at your revenue target and base it on actual data. And that's not only financial data. It's non-financial metrics as well. Some might refer to it even as leading indicators. And an example of that is looking at your customer attrition, right? How many customers are leaving your business? Because if you know 15% of customers or 20% of customers leave your business, and now you're $1 million company, you're actually going to have to, just in order to get to the same $1 million next year, you're going to have to make sure that you get those 15 to 20% of customers just to hit that same revenue goal, right? And that's why it's important to understand that, and I put the example below, right? It's very different, and there's different stages as you, let's say, double a $300,000 company is very different than doubling a $3 million company, right? So think also in terms of rate of growth, right? So if you double a $300,000 company, then you hit 600,000, but that rate of growth is actually $300,000. So then if the next year you want to grow by another 300,000, you're going to get to 900,000, right? And if that system and that rate of growth is working, then you know that is reasonable based on the systems and the processes that you have in the company. But if you want to go from 900,000 to 1.8 million and double the company, there's a big difference when it comes to that rate of growth. You're actually more than quadrupling or 3xing that rate. Now, do you have the recruiting systems in order to support that? Do you have the marketing systems in order to support that? Do you have the operational systems and the training processes, right? So thinking about ultimately what, similar to how we mentioned in regard to facility expense, and if you double your company, what would break first, right? Would you not have room for your office manager or, specific areas of your yard? You think in all aspects of your business, but I think it's really important when you're thinking about that revenue target, be as realistic as possible.
I also want to contribute to the conversation that's going on in the chat about different systems like LMN or Synced Up that you can build a budget and derive your estimates off of that budget, which is a powerful tool. That's what you want to do, is make sure that your estimates are derived after your budget, because then your budget is what becomes your profit and loss and your reality and your financials for the year, right? But a lot of people look at this as a one and done situation. I'm going to implement my budget on Element, Synced Up, whatever CRM that you're using, and that's it. I should be good for the rest of the year, right? No, you're not. You're not going to be good for the rest of the year. I think you've done the first step in order to take control of your financial situation. But the most successful companies that we work with is we're meeting with them monthly to review their budget that they have in Element or Synced Up or whatever other software. And we're saying, okay, well, this is what you budgeted for January. Well, let's plug in your actual numbers on your P&L for January. And what were the differences? Did you do better or worse than we expected you? And why? Why if you did worse, and why if you did better, than why? And it is our job as business owners to know the reason why. Like if we see a difference in numbers, it could be, one of the reasons could be, well, my truck broke down and I needed new equipment to repair it or whatever, or we ran overtime on that job. It's just not quoted correctly for the right amount of hours, and as you go along every month, you have these lessons that you learn, and you make sure that it doesn't keep happening in February, March, or you adjust your budget for them. And then that's how your budget becomes your actual profit and loss. It becomes your reality, and you become successful in that. And that's what our most successful companies do, is we have a budget, but we're reviewing the actuals every month. And well, what are the differences? Do we have to go back into Element and update their numbers for them, right? And I'm not saying that you have to do that with us or our company, but it's something that you as a business owner could do every month after you see your financials, or you could do it with another accountant, whoever it is, your spouse. But it's so important to review these on a monthly basis.
Absolutely. And looking at the P&L is going to give you a lot of great insight. I think also considering a lot of the balance sheet items, and we had brought up before a lot of the challenges that the green industry faces on the financial side. And ultimately what that result is the net cash flow of the industry is typically around 0 to 1% of revenue, which is something I think we really want to improve, right? So does each one of your team members understand what their impact within their role is on the financial health of the company and the cash flow perspective of the company? Making sure that they understand, right? How important is that? Having those conversations, keeping this stuff front of mind, because the team will just assume things, right? And it may not be right. So always remembering to maybe include them in certain conversations. You don't have to tell them your net profit or whatever it is, right? And we're actually going to have Ryan Markowitz share in regard to a bonus plan. That'll be tomorrow. And then even the conversation that we were just having in regard to softwares, Element and Synced Up are great in regard to budgeting. But Mike Callahan is going to dive into software expenses and just that deep dive tomorrow as well. So, hopefully we're going to give even more clarity into that. But in regard to cash flow, again, looking at debt management, also something that's not the most exciting thing and not talked about a lot is managing your accounts receivable and accounts payable, making sure that your customers are paying you. That's going to have an enormous impact. You can be very detailed in your budgeting and focusing so much on your estimating and your processing, but if you're not collecting on progress payments and you don't have a standard process for that, then that's going to limit you more than anything, right? That could be the major bottleneck of your company. So.
Awesome stuff. And one example that I have is we had a business owner that had a mechanic on staff, because they just, they're a larger company and have enough equipment and vehicles that needed to be repaired, right? And at that point, if you do have a mechanic on staff, you don't want to spend a lot of money on the repairs and maintenance, right? Because that's why you hired a mechanic, is so that you kind of minimize that cost. And so when we were building out the budget for the year, that business owner was very adamant of communicating the repairs and maintenance budget to that mechanic and saying, hey, this is our budget for the year. And if items come up, we need to be creative and very thoughtful and intentional about the tools that we are buying to repair any items that do. So maybe when it comes to sourcing materials, they are shopping online for the best deals, or getting more creative with the methods that they're using for repairing certain items, right? So another thing is if you see that you do have a lot of repairs and maintenance items, or you're having to issue refunds because of quality issues to your client, right? Different things like that, that you want to hold your team accountable to. And I think somebody mentioned that in the chat too. It's like when you have a budget, you can hold your team accountable to that, or at least you have a direction and where you want to go, and you can spread that message to your team. But you have to have they have to have skin in the game too. And how do they have skin in the game? Is like you tie their pay to it. So perhaps you have quarterly or biannual bonuses that you give out if the staff member meets budgeted hours, right? If their projects come out with a certain quality, if they don't break anything on the job site, or for that quarter, or for those 6 months, then they get a bonus based off of that. And when you set those expectations and that scorecard in front of them, and you put a system in to track all of that, then that's how you get buy-in from your team, because that could mean a road trip for them. That could mean extra groceries, right? Like they may be motivated by that, and it's a way to gamify it too.
Absolutely. Yeah, and that's it's a big part, especially as you grow a company. And you can have the best plan, right? And Fred Haskett had mentioned just all the different aspects when it comes to the plan and taking action and all the things that go into that. But ultimately, you want to keep a close eye on the certain risks within your company. And you don't want one thing to ruin your whole plan and your whole plan for success for 2026. So it's important, yes, to think about all of those exciting things and things that you can add to your company, and all the things that can make your company better. But at the same time too, it's important to always run scenarios through different aspects of your company. What if this person leaves? What if this happens to the company? Trying to really think about what that plan could be, so that if those things happen, instead of it being more of an emotional response or something that totally destroys your company for that year or causes you not to grow as much as you'd like, you already have a system and approach that you can actually handle that and actually succeed even past that. These are the certain things based on risk that you can look into. So client concentration. Are there any customers that make up more than 10% of total revenue of the company? That could be a risk, especially if they leave. Looking at credit risk, right? How much are you relying on certain customers to pay you over certain extended terms and different aspects like that? Liquidity risk, looking at cash flow concerns, both in the short-term and long-term perspectives. Another big thing is, I think a lot of companies want to progress and want to earn more revenue, and oftentimes try to take on larger projects, whether it's on the commercial side, on more maintenance work, or maybe it's more the outdoor living, getting into something where now instead of subbing out a lot of the work, now you're going to handle a lot of it internally, right? Handling those larger jobs equals more risk, right? So you're going to want to make sure that your job costing is dialed in, that your profits are high, because if you didn't hit your profit goals on a $5,000 job, it's probably not going to make or break you. But if you don't hit your goal on a $200,000 job, that's going to have a bigger impact on your company, right? So it makes it even more important to dial into your numbers. Also look at loss leaders, right? As I mentioned before, this is a very people-intensive business. This is something that there's a lot of different stresses, right? And a lot of things that you're having to manage as a business owner. Is it worth breaking even or losing money in an entire division just to be able to sustain your company and maybe be profitable in another division? Or can there be a model that is more equally distributed in regards to profits for each division? And this, again, when it comes to risk, this can help to hedge against different changes in your market. As many of you have seen, those of you that have been around during 2008, and even in recent years, looking at certain installation-based companies in different markets throughout the country and the ups and downs of that. Building in redundancies, right? If you have some key team members understanding that, and having a deep understanding of all those roles, making sure that the SOPs are built in so that if they do leave, we have a system to fill that in, even if you as the owner have to step in for a little bit, but it allows your company to keep moving forward. Also, things like building up a cash reserve, right? These are all things that you can do to prepare your company, because oftentimes companies don't reach their goals because it's things like this that happen to them, and then it discourages them, and it even can put you back an entire year, right? Or multiple years, right? So instead of hoping that these things don't happen, almost expect that some of this will happen, right? And think about, how can we adjust? What is that plan that we need to do? Because especially for those of you that have been around for 10 years, 20 years, or even decades in business, the reality is a lot of these things happen. So it's trying to come up with that plan to really tackle it. And also just sharing some general benchmarks as well. So when it comes to direct costs, so everything that is related to the work being performed on the actual project, so not taking into account any overhead or administrative costs, you can see over to the left, the green industry companies that didn't provide more than 75% of any given service line did around 51.77%. And then you can see the installation-based number, reoccurring-based number. Typically, installation is going to be higher, right, when it comes to direct costs, because you have more materials built into that, right? Now look at your overhead costs, and these are the industry medians up year to date up to the end of November of 2025. This is specifically for companies over $500,000 in sales, and it should be relatively similar even for smaller companies as well. But this is just as an example, and just kind of as you think about some of the data within your company. So you can see overhead costs. Companies that do installation-based work, they typically don't have thousands of customers, right, that they're having to manage, and the routes and the different things going on. So overhead's typically a little bit lower with that, whereas reoccurring businesses, maybe more maintenance, lawn care-based companies, we're seeing a little bit higher in regards to the overhead costs there. So again, you can use these benchmarks to kind of help as you're budgeting for next year. And when it comes to looking at your budget, ultimately the goal, right, is hopefully you have financials to look back at from 2025. If you don't, reach out to an accountant. That's something we can also help with as well in regard to cleaning up your books and accounting, because ultimately you want to be able to see, how did the company perform, right? And then it comes down to, what is that plan for 2026? And oftentimes people might look at certain expenses, and you might look at the company and look at profitability, and your gut feeling might be, okay, maybe we actually need to cut costs in certain areas to hit the profitability goal for next year. However, that isn't the only solution. Oftentimes, what is actually happening is you might just not be at capacity with that given crew, or that given employee, or even that given piece of equipment, or the truck that you have, and those fixed assets. So also thinking in terms of that too. Also, it could be certain efficiency opportunities, right? So that's where you can really look deep into the P&L, similar to kind of what we're doing yesterday and today, and really diagnosing whether you're comparing it to industry averages, or you're seeing, okay, what is that rate of change? Why did my material costs go from 8% last year to 12% of revenue? Why did my overhead go from 30% to 36% of total revenue? Looking at those things and figuring out, okay, what for each one of those line items, how can we optimize that and really improve it when it comes to some of those efficiency opportunities. And then the other aspect as well, and we're going to have the speakers cover this too today, and it's, you can be very specific and you can get very granular into looking at certain efficiencies, being very on top of your team, holding people accountable, making sure that you're utilizing the right equipment. But at the end of the day, if your pricing structure is off, then you're going to put yourself in a position where it's impossible to succeed, and it's not going to be easy to make a profit. So oftentimes, as you're thinking more from a bird's eye view and you're looking at your plan for 2026, oftentimes it can fall into one of these buckets. Next, Carla and I are going to be taking a deep dive into overhead salaries, ROI versus the low cost approach in regard to certain overhead items, and more in regard to that as well. So we'll get started with that. So as you're looking at the overhead for your budget, some should be evaluated more from the perspective of what value can be created based on that line item. Or can we get an ROI based on this? Instead of looking at it more from the perspective of, let's just try to find the lowest cost option for that given line item. And different examples when it comes to, what are some of those line items where you should look at it more from an ROI perspective? Things like marketing, software, professional services, employee training, leadership and development, recruiting. Also things that impact client experience. That's worth a lot more, right? Looking at things like how you're paying your sales team, or even as Ryan covered earlier in regard to the bonus plan. These are all things, and again, like just as an example, those things that could be done for clients, right? And enhancing that relationship with them. What is the impact that has on total enterprise value and just your ability to continue to service them and can continue to run a thriving company, right? So looking at that ROI perspective, because it might not, you taking time, or one of your account managers taking time to do something that might cost a little bit more, it could pay off a lot better in regard to not only that account manager feeling like you care about your customers and the company, but also that client really feels it as well. So, sometimes you really have to look at things more from, okay, what value and what is that ROI that can be produced based off of that. Whereas some of the items where it's more of, okay, let's just control the cost, things like office supplies, utilities, aspects of insurance, facility expense, fuel, uniforms, right? So where, again, Erica covered a lot of these yesterday in regard to, okay, how can we negotiate with some of these vendors? And, how can we look into some of these expenses, making sure that we're reviewing it month after month, making sure that, nothing is increasing too much, especially as a percent of revenue. So again, I think it's important to really kind of separate, when you're looking at the financials, what are some of those items that you can look at more from an ROI versus more of just, okay, let's cut that expense. And a big aspect, I think of something that companies don't look into as much is looking at overhead labor, right? So think of that as anyone in your company that's not actually physically touching the work on the projects. So even if it's management and they're going to the properties, or maybe it's your office manager or COO, these are all aspects of the company that, ultimately when you build out your chart of accounts, which is basically like the buckets that all of the transactions get categorized into, when you break that out, you want to be able to see, okay, this is what our direct labor was, and then this is what our overhead labor is as a percent of revenue. Without breaking that out within your financials, you really have no view into how efficient each one of those are operating for the company. So definitely recommend making sure that within your chart of accounts, those are separated, because without being able to see some of that structure and having that foundation set, it doesn't allow you to analyze it and dig deeper. And that even goes for a lot of the other aspects of the financials as well. Whether it's making sure you have a clear gross margin number, and so that way you can see, okay, how well is our team performing in the field. In regard to overhead salaries, it's important to think of this more based on total revenue that the company has, and how much based on the revenue can the company actually afford when it comes to paying out overhead salaries. Can a $500,000 company afford a full-time office manager? Right? Can a $5 million company support 5 overhead staff that don't help with any work on the projects? Right? So those are things, as you look at your financials, base it off of revenue, because as Mike Callahan went over before, there's things like software and automations and different things that can be built in. And before you look to add someone, always think, okay, is there a software that can help solve this? Is there a certain process that we can implement? Or is that step within your company even necessary, right? To make sure that you're fulfilling the core services in your company. Also, make sure that you're matching what that administrative team member's expertise is and what their expertise level is with the appropriate tasks. Similar to how when you might purchase a great piece of equipment, but at the end of the day, are you using it on the wrong kinds of projects? So this is something, especially when you think about overhead salaries, if your management level team members are handling tasks that an entry level person can handle, you're technically losing money in that scenario. So that's something to really focus on as well. And the main role of overhead in general, and then overhead salaries really being the biggest expense within your overhead, is to support the core operations, right? That is their entire goal. Their goal is not to do the work on the projects. Their goal is to be there as a support. And there is such thing as being too lean or not having enough overhead staff, especially when you don't have the systems and the software to actually make sure that things are operating the right way. Typically, for when it comes to overhead salaries, so again, that's anyone who's not actually physically touching the work on the projects, you're looking at around 8% for more of the installation-based companies, and then closer to maybe 10 or 11% when it comes to the reoccurring maintenance type companies, less material-intensive companies. So looking at that as a rule of thumb, so $1 million company, you have a bucket of roughly 100,000, right? $10 million company, $1 million. $500,000 company, around 50,000, right? So when you're smaller company, it could be mostly yourself handling all that stuff. But again, if you decide to hire a full-time office manager before you can technically afford it based on your revenue size, you could do something like that, but then it's more pressure, and it makes it even more important for the company to generate revenues in order to support that. And ultimately, again, going back to what that plan looks like for 2026, if your overhead was inflated in 2025, it's making that decision, right? Are we going to maintain a lot of the team that we have and try to really support the operations moving forward and generate revenue in order to support that? Or are we going to make certain cuts? And sometimes we come across that with companies that we work with, where there's that realization of, maybe, it sounded like the right thing to do, right? It might have sounded like the next step of running a business, right? Getting a facility space location, hiring in office management level people to do different tasks. I think something that we see sometimes is, certain internal team members, and we work with some phenomenal ones, which that's a whole nother story. But, I think it's, the same way that you obsess about the work being done on the projects and holding people accountable, showing them what success looks like, making sure that they're being efficient, that there is those standard operating procedures set up. Put that same focus when it comes to your administrative team as well, because you don't want to, you don't want that to be where your waste is. And anytime, whether it's overhead staff or just any overhead cost in general, always think twice before you incur that, because ultimately that's not directly generating revenue for the company. It's more of there as a support for your operations. And then what this turns around to is this also becomes a competitive advantage for the company. Now you're able to manage this well, implement systems in your company, software, making sure that your administrative team and your operations team are on the same page, flowing very nicely. Now, when you go out and do a bid for a project, you're operating at 28% overhead. Your competitor is operating at 37% overhead. Now you build in an estimate for the same profit margin, and now you could potentially get the job because you're able to price it lower, right? Because your overhead is not inflated. So again, look at it as a competitive advantage. We truly believe that dialing into the numbers like this is where you can really, things get really interesting, because you can really, build that confidence with your pricing structure and make sure that you're putting yourself in a position where you can succeed. So. And if anyone has any questions on that, definitely let us know. And also, before we move on to the next speaker, just want to thank everyone for joining us here today. A special shout out to Cycle CPA clients, because without you, we wouldn't have the time and the resources to invest back into events like this. So we really appreciate the opportunity to do business with you. And if you're sitting there not a Cycle CPA client, we don't hold anything against you, but it's you can always reach out to us if you have any questions as well. But again, just want to thank you, and another thank you to the speakers, which we still have a few left here as well for today. But just wanted to mention that here.
Yeah, love our clients and everybody that has attended here. And if you don't mind, Joe, I just want to share my screen onto a budget spreadsheet. Not that we need another budget spreadsheet, but I just want to kind of drive home a point here in regard to the overhead expenses. So let me just share my screen real quick, and then you all can tell me if you see it in the chat, if you're able to see my screen. Oh, there it goes, popped up. All right, so as Joe went through, you'll have your, let me zoom in a little bit better so you guys can all see. You have your overhead budgets, right? For each month within that next year. And you could split it up between fixed and variable costs. And your fixed costs are, first of all, overhead expenses are items that are not directly related to that job, right? So think of things like telephone, you can't trace that back to a job, rent, overhead salaries, like Joe mentioned, right? And what fixed means is that this expense is not really going to increase and then decrease every month. It's pretty much the same, right? And so, your rent's going to stay the same. Overhead salaries, they're probably on a salary basis, so that probably stays the same, and so on and so forth. And then variable means that as your revenue goes up, advertising is going to go up, right? It's going to come down, stuff like that. So just, budgeting for overhead costs, but not only that, so this is the company-wide budget for overhead costs. But then splitting it up between divisions. And I know day one yesterday, somebody spoke about this. And the reason why it's important to split up your budget by division, if you can, and if you have the information to do it. Sometimes when you're just starting off, it doesn't make sense. But if you're an established company, or if you've been in business for a few years and you kind of have your division set, it definitely makes sense. And I'll tell you why. So here in column O, we have design build. Column P, we have maintenance. Now, one of the biggest differences that I see off of the bat is this design build number here, 226,000, maintenance only has 30. Now, what is that? That is the overhead salaries allocated to those divisions. What does that mean? It means that for this company in particular, they had more managers, supervisors working in their design build division than they did in their maintenance division. Okay. And as you can see, though, for the company and for all companies, really the most heavy or high product line item is probably the overhead salaries is what's going to make up a lot. So out of this 257 for the entire company, 226 actually is allocated to the design build division. And only $30,000 is allocated to the maintenance. Now, what does that mean for your company and for your pricing and your estimating? That means that your overhead rate per hour, the amount of overhead that you have to recover for your design build estimates, is much higher than your maintenance. Here we have it almost as close to $25 an hour that I have to recover for my overhead for design build projects versus my maintenance. I only need to recoup $15 per hour from my maintenance division. And, if I get an average of these two, right, it would be almost $20 an hour company-wide, right? So now, if you were to use a blended rate, what are some disadvantages of that? First, I think that you would probably maybe lose out on more contracts or bids for your maintenance contracts, right? Because instead of bidding it at $15, not at $15 an hour, but for the overhead recovery at 15, now you're doing 20. Right. And for your design build, those services typically you can bid at a higher revenue amount, which you could allocate the $25 per hour to. So I think that the sooner that you can build it out by division, the better. And if you're sitting there and you're like, hey, my managers work in both divisions, how do I do that? What we do is make an estimate. So if we have a manager that works on both divisions, we say, okay, well, do they work on the divisions 50-50? So we allocate 50% of the salary to one and then the other, or is it more of an 80-20 split, 70-30, whatever that becomes. But even though it still becomes beneficial to split that out for that reason. But just wanted to share that pretty quickly with you guys. And
and it's
get over.
And it's worth doing that allocation because, like Carla mentioned, the overhead salaries is the largest item within overhead. So it's worth taking that extra step, especially when you have different business models between the different service lines. You want to make sure that you're being honest there. But awesome stuff. And, again, these are the not so exciting things about budgeting, but it's, it's important to really dial in as we think about next year.
Thank you for listening to today's podcast episode with Joe and Carla of Cycle CPA. Once again, cyclecpa.com or go to @cycle_CPA on Instagram, or go to Landscaping Accountant on Facebook, that Facebook group there, to find out more about all the different content that they do offer. Start following them and get that conversation started today if you're looking for bookkeeping, accounting, CFO services, especially with somebody who specializes in our industry. And we look forward to meeting you next week on the How to Hardscape podcast.